Alrighty. Hi, Scott. Welcome to our podcast. Please introduce yourself.
Thanks for having me, Donnie. My name's Scott Graham and I'm a finance broker, mortgage broker. Been in the industry. I've been in financial services for 15 years, first in financial planning and now, made the crossover. We did financial planning and mortgage broking and now just purely finance. So for about the last 10 odd years, something like that.
Okay.
So,
and where do you normally base anyway?
South side of Brisbane. So we're based in Sunnybank.
Yes.
But mortgage broking is something, especially with COVID, with, doing online Zoom meetings and that sort of stuff. Yes. Clients all over Australia. So, yeah.
Okay, great. So today we're basically trying to cover some of the aspect like first home buyer, which is one of the segment, which is very important these days anyway. The second one is investors looking at buying for investment property.
Yep.
The third one is guarantor, where the parents are actually using their equity to using the equity for the kids as a part of the deposits.
Yeah. Yep.
So those are the kind of the aspect that we try to cover today.
Okay. Yeah. No, that sounds good.
Yeah.
Yeah.
So in terms of the first question that I'd like to ask you, Scott, what would be the criteria or procedures and steps for a first home buyer looking at buying property anyway?
Yeah, okay. So for first home buyers, and I suppose some of this will feed into that last bit about parent guarantor. So banks are basically looking for three things. I mean, they're looking for a whole lot of stuff, but if we want to summarise it, they're looking for three things. So one, the buzz term is serviceability. So that's your income and expenses, working out how much you earn, what your expenses are, and then working out according to the bank's criteria, can you afford the loan? So can you make those repayments on the loan?
Can you service the loan? Yes.
Can you service the loan? So servicing is the term that gets used there. So that's number one. Number two is your equity position. So that's having some sort of deposit. Banks in Australia will lend up to 95% usually. So having some sort of deposit. So having a 5% deposit.
Yes.
The two magic numbers when we talk about equity are 95%. And then the next magic number is 80% of the value of the property or the loan to valuation ratio. So LVR. Yes. Is an acronym. We love acronyms in lending. So the LVR. So if you're ideally, you'd have a 20% deposit. Yes. And you'll avoid LMI. So if your LVR is 80%, you'll avoid LMI. LMI is the lender's mortgage insurance.
Because the lending mortgage insurance fees is quite high, isn't it?
Yeah, it can be like 3%, something like that at that sort of higher level. Yeah.
Which is substantial for most of the first-time buyer anyway.
On like a $500,000 property, that's $12,000, $15,000.
Yeah, you can actually use that towards the renovation.
You can buy a boat. You can do all sorts of stuff with 15 grand. Yeah,
exactly.
So they're number one, servicing. Number two, your equity position, and then number three is your credit file. So all banks will have a look at your credit file, and they're trying to sort of make a determination of your creditworthiness. Yep. If you've missed payments or you've got defaults or that sort of stuff. Yes. It's not that you're not out of the game. It's just that the banks will all look at that. So as part of our process, we used to just, if you go back 4 or 5 years, if you'd said I'm bankrupt or I've got a default on my file, we would then pull it. We pull it every time before we send it to the bank now to have a look, for undisclosed debts and that sort of thing.
In advance.
Yeah. So for first home buyers, if we run through those three things, number one, servicing, having a good job, being in a position where you're earning good money, but also trying to keep your unsecured debts, so car loans and that sort of thing.
Yeah.
Trying to keep all that stuff down. Number two is your equity position, so having either savings and this will lead into the parental guarantee sort of stuff.
Yep.
If you haven't got those savings, the bank of mum and dad that's the cheapest money you're going to get.
Yeah. So talking about the in terms of the credit file.
Yep.
So would you suggest that in terms of the first home buyer, what they should be trying to do is try to get the credit score as high as possible in terms of like, not to have in terms of the credit cards, like in terms of debts or bills and,
Definitely,
loans or car loans and, we're talking about buy now, pay later. Because everything will be pretty much affect your credit score, right?
Correct, yeah. So the things that affect your credit score are, number one, not making payments.
Yep.
You go out and buy a jet ski and you don't pay Yamaha Finance the $85 a month.
Yep.
That will show up on your credit file. And you got to remember that banks are looking at this to say, well, how good are you at making payments on your loan?
Yes.
That's the idea of it. So if their credit file is showing that you're consistently 1 or 2 months late,
Yep.
the bank will say, well, if you're not very good at paying back $15,000, we don't want to lend you $500,000.
Yep.
So,
inconsistent and uncertain.
Yeah. So making sure that credit file is as clean as possible. We pull the credit file on our client's behalf every time now just to check that sort of stuff.
Yep.
And we'll be having those conversations before we go to the bank. So saying, we can see that you've missed a couple of payments last year on the personal loan. What's the story with that?
Yes.
And it can be simple stuff like, look, we just changed from ING to Commonwealth with our bank, and there was a bit of a mix-up with the direct debits.
Oh, yeah, yep.
Simple stuff like that. And so when we send our application to the bank, if we're saying to the bank, well, we know you're going to see this, here's the explanation, and it's in isolation, we've sort of covered off on that. And so the bank, not always, but the bank will usually go, well, we appreciate that we haven't gone looking for it. You've been forthright with it, and you've provided us with an explanation. This is, that's okay. It's an isolated incident.
For instance, just say if they can't, or if the bank declined their first application due to the, late payments and, default and that sort of stuff, when do they supposed to kind of like revisit the loan again?
Yeah, so a bit like your driver's license, where you've got, well, in Queensland, you've got 12 points on your license.
Yep.
If you get a seatbelt fine and lose 3 points today, that will fall off the back of your license 2 years from now.
Okay.
So credit files are the same. So it's a rolling sort of period. So your credit file goes for 5 years, but they've actually got they've got the payment history for 2 years.
Yep.
So if you miss a payment today, for example, if it gets onto the credit file where it gets to that stage where it's 30 days late or 60 days late, it'll be there for 2 years and then it'll fall off the back of the credit file at that 2 year mark. All this is we're trying to identify this stuff before we get to the bank. If we think that we're not going to do so well at the bank, there's a bit of a cottage industry in credit repair. So there's a whole industry around, because people do end up with this stuff on their file. The classic case is usually, I was renting a property with friends and we had either an electricity bill or a telephone bill. Sharing. I moved out, didn't think about it for the next 2 years until I came to Scotty to get a home loan.
Yeah.
And here we are with Telstra. I owe Telstra $340 and they've listed a default. If that's the case, it's not an area that I work in, but there are people that can help you explaining that, and you can go back to Telstra or whoever, or they can on your behalf and try and fix that and say, look, it's an honest mistake.
Yes.
You just couldn't find us. We didn't realise. If we pay it now, what can we do? So,
So as soon as you have someone to back it up and say, well, this is the scenario. They basically will kind of look at it.
And option two is you've got the mainstream lenders that are very much black and white that are, yes, we'll give you the money, yes, we'll approve it, or no, we won't. So approve or decline. You've then got non-conforming lenders or sort of second-tier lenders that are more shades of grey.
Yeah.
So Commonwealth Bank, the rate might be 5.5%. You might go to a Liberty or a La Trobe or someone like that, and they'll say it's a no at 5.5% because we can see what's on your file, but it's a yes at 6.5 or 7% or something like that.
And it's up to you whether you want to take it on.
Yeah, and people will, in those situations, no one wants to pay, they go, well, my mate had a rate of 5.5. Why would I want my home loan to be 8%?
Especially these days.
especially these days.
You know,
it's
when
expensive.
you're talking about a standard home loan rate is probably about 5.5 now, or maybe close to 6.
Yeah, it's getting towards 6.
So if you talk about other lender like Trop or the other boys out there, it could be up to 8%.
Yeah.
That's as close as commercial rate.
Exactly. But the sort of the strategy is that it gets you where you want to go now. You keep your nose clean, you keep making payments and stuff, and in the future you can refinance, you can come back into mainstream. So you take the 8% to get into your home now, and then 2 years from now we come back and say, well, whatever it was that got you, that the mainstream guys said no, we're now looking good. We're now looking like they want us to, so we can refinance out of Latrobe or Liberty or Pepper or whoever. And some of those lenders like Liberty and Pepper, we can go back to those guys even and say, well, we were at 8%, but we've now been a really good customer for 2 years. Can you give us a better rate? And they will, not always, but a lot of the time they will come back and say, well, we can see that you've made those consistent payments.
As long as you keep your nose clean, then.
Got to keep your nose clean.
Yeah. Is there a website that an individual people can actually check their credit
files? Yeah. So there's 3 credit repairs in Australia. Equifax is the one that most banks seem to use.
Equifax, yeah.
Yeah. So you can have a look on Equifax. There is other credit repair, like you see them on the telly. There's other credit repair, get your file for free kind of.
Oh, yeah.
I'd say don't go to those guys. You want to go straight to the source. You want to go straight to Equifax.
Yes.
And they'll give you 1 copy of your file for free every 12 months.
Yep.
Alternatively, you can get a subscription, which is, I think it's about $70 or $80 a year. And then you can log in and have a look.
Yep.
When we do it as brokers, we're sort of participants in the finance industry. So we get what's called an access seeker inquiry. So if you go and get a car loan from Macquarie or someone, they'll actually you'll see the inquiry on the file. When we do it, we're saying, well, we just want to have a look to see what's there. So it's like a soft touch. So it doesn't affect your credit score when you come through a broker to do it. Not just brokers, but when you use those soft touch, I definitely recommend doing that as opposed to the free ones on the telly, because a lot of the time those guys, if you're inquiring about your credit score, you don't do that on a whim. You're looking to borrow money for something, and those guys will use that to potentially to say, well, here's a couple of options for car loans. Do you want to have a car loan or do you want a personal loan? So you may start to get a barrage of emails and text messages about click here for instant approval and that sort of stuff. And if you're going for a home loan, you don't want that stuff on on your file.
When it comes to in terms of the credit file or credit rating, so when you're actually trying to apply for a home loan, there will be a questionnaire in terms of whether you have car loans or whether you have whatever loans or debts and that sort of stuff. Do you require to fill out as much as possible, and in terms of try to get as much as accurate as possible?
100%, yeah. So the bank wants to get a really good picture of your situation. If you don't tell them about the Yamaha finance loan, a couple of things can happen. So one, they can see it on the credit file. So finance institutions or banking institutions are now reporting to the credit agencies, and so that's where those repayments are showing up. So they can see it in there. Number 2, banks are asking for bank statements. So they'll say, we want to see the last 30 days of your bank statement, and we'll look down and go, Yamaha Finance, $83. I keep on using Yamaha Finance. It doesn't have to be Yamaha.
Because everything will be pops up on their screen, on their system anyway, right?
Well, not everything, but the theory is if you're sending them 30 days, you usually, the longest period you can go between making a payment on finance is usually a month. Might be a week, might be a fortnight, might be a month. So if they get the last 30 days, the thinking is that you're going to see a snapshot of any debts that you've got. So if it shows up there and they see it and you haven't disclosed it, it just leads to a bit more suspicion.
So by all means, honesty is the best policy.
Honesty is the best policy, because if they find it and you haven't told them about it, it leads to suspicion.
Because they could, as soon as they found that the application can be a little bit suspicious, and they can decline your
they might have a little microscope to start with. They'll get a big microscope out after that. It can happen. It can happen. like on the credit file, people can go to Harvey Norman or the good guys and buy a couch or a telly.
Yes.
And they'll do the interest-free, pay it off, and then forget about it. And then when we pull the credit file, we'll say you've got a $6,000 Latitude credit card, and they can freak out and go, "Oh my God, someone's got a credit card in my name," you know. But a lot of the time, it's just that you've bought a fridge, telly, couch, and you paid it off and didn't think about it, and the facility is still open. So it's just a matter of saying, well, we either need a statement for that, or you just ring the institution and say, guys, can we cancel that? And they'll send you a letter to say, as of, whatever the date, this facility is now cancelled. And the bank's okay with that. Because, again, you're sort of disclosing it, you're putting it out there to go,
True.
We've found it before it gets to the bank, as opposed to the bank finding it there and going, oh, hang on, we've got a credit card here that you didn't tell us about.
Yep.
Let's start looking for other stuff.
Yeah. For first home buyer, are they allowed to use the low doc? Or are they still exist?
Low doc's getting harder. So low doc, I suppose to explain, low doc means low documentation.
Yep.
With a normal home loan, you need pay slips, or if you're self-employed, financials.
Bank statements, and you got for businesses, you got financial profit and loss statement. And you name it. There's a lot of paperwork out there.
Low doc's definitely getting harder. So the accounting bodies, so the CPA and the CA, are both now telling their members not to sign off on those letters because it leads accountants to be liable. Because the letters are very specific. It used to be that you just get the accountant to sign a letter to say, Donnie's earning $1 million. I'm his accountant, and I think that's reasonable. Where now the banks have got very specific letters, and it'll say Donnie's taxable income is such and such. Yeah, and the accountants or the accounting bodies are worried about the liability, as I understand it. So that's why it's getting harder. So more and more accountants are now saying we won't sign those letters.
Yep. So there is more accountability, and in terms of more.
Yeah. So it's definitely getting harder. I think there'll always be a place for that because it is. I mean, if you're self-employed, you don't. If the financial year ends on June 30, you don't run out and do your tax on the 1st of July and have it ready to go. And that's sort of where low doc fits, that you go say, well, I haven't done it, but the accountant says we're good for it. So it's getting harder, that stuff.
So in general, there's not much out there in terms of the.
It depends on your accountant. If your accountant's comfortable signing off on those letters, if you've got an accountant you've been working with that's comfortable signing the letters, it can work. But definitely, the accounting bodies.
Most unlikely.
It's getting harder, and more accountants will not sign them moving forward, I would think, because they're accounting bodies. A bit like the REIQ or the industry body is saying we don't think that you should be signing letters. They still do exist. There's still a place for them. Banks still offer them. Not all banks, but so the mainstream guys have all moved away from that. But so
the big boys out there like ANZ and Westbank. And
those guys aren't so keen on that stuff. But the second tier lenders, Latrobe and those guys are still doing it. But the issue is usually at the accountant. It's not an issue, but the accountant saying yes I will, or no I won't sign that letter. So but it works well if you haven't done your tax, and that's what it does. That's what it's supposed to do.
Yeah. Let's move on to the next segment, which is investors. Is there any difference in terms of criteria between an investor's application and the first home buyer, Scott?
It's similar criteria. So they're still looking for servicing, equity position, and credit file, those three things. I suppose with an investor, instead of having cash, like with a first home buyer, you might need $20,000 or $40,000 or $40,000 cash. You've actually usually got a property, an owner-occupied property or another investment or something like that you can...
Refinance,
you can pull some equity out of, so you don't need cash per se. You can use the equity. So
a different type of saving.
Yeah. And I mean, not that there's a lot of reasons to buy property, but equity is definitely one of the great reasons to own your own home.
Yes.
Instead of just paying rent, you're actually, if we have a look for the last couple of years, if you'd bought a property anywhere in Queensland for $400, it'd be worth $600 now,
Yeah.
and that's equity. You know, you can do things with that, which is great.
Well, having owned, 6-7 property myself, in the past, few years. So I do find out that with the last, 3-4 years pandemic, I actually make a lot of money out of the equity.
Yeah.
And using those specific equity to purchase a lot of other property.
Yeah.
And, it couldn't be any better, because you're trying to basically using that particular equity without using the cash to purchase other property, and then hopefully other property will make another 20%.
Yeah.
In the next year or two, and then you just keep rolling on.
Yeah. Well, they say Einstein said compound interest is the eighth wonder of the world. I don't think it was him, but the concept is incredible, that if you've got a market that's rising 10% a year, if you got one property worth 500, 10% of 500, you've made 50,000. If you got two properties, you've got two properties that are worth 500 each, that's $1 million.
Yep.
10% of $1 million is 100,000. So you're making the leverage that affords you is, it's in a rising market. It's great. I suppose it's interesting coming from a financial planning background. It's a bit like Ford versus Holden sometimes with shares and property. You go to the barbecue and say on Saturday and say, are you into shares or property? And you'll get, everyone almost draws a line in the sand and, property's terrible or shares are terrible or whatever. Definitely, I think property, that ability to leverage, like you can take, you can have a 10% deposit. So let's say a $500,000 property with $50,000, you can buy a property worth $500,000. If it goes up by 10% on your original 50,000, you've doubled your investment. Very hard to do that. You don't get the same kind of leverage in the stock market as that.
No.
Different characteristics. You can argue diversification, in the stock market, not all your eggs are in the one basket, where property, you've got one property in one spot and that sort of thing. But yeah, definitely in a rising market, that ability to leverage, you can take a 10% deposit or a 5% deposit as an owner occupier and buy an asset, borrow 95% of it. That leverage, and it does work both ways. If in a market coming down, it works against you. But
yep.
If we have a look at the last couple of years,
I can't see any decrease in the last 5 years anyway.
No. It definitely. It's gone gangbusters. Yeah. So that leverage, you just, like a rising tide lifts all boats. Buying property anywhere in Australia, well, not anywhere, but in a lot of locations in Australia.
Yeah.
You've inevitably done pretty well in the last few years.
And moving on to the third segment, which is the parents, guarantee.
Parental guarantee?
Yeah. So how does it work in terms of using the equity of your parents to be guarantor for your investment property? For buying a property as a first home buyer? Yeah.
So if we go back to those three things, your credit file can be fine. You can be earning good money, but the equity position for first home buyers, if you're renting and you're paying $500 or $600 a week in rent, it's really hard to put together $20,000, $30,000, $40,000.
Yeah, everything pretty much used up.
Very hard to satisfy that part of the criteria. And that's where the parental guarantee comes in. That mum or dad might have their property or an investment property, and the banks will let you tap into that.
Yep.
So, and the way that works is they say, well, Donnie's buying this property worth $500,000. We'll lend roughly 80% of that, so we'll lend $400,000 against the new property. So that means we need 100 and whatever it is, 100 or 110,000. We can draw that equity from mum and dad's place.
Yep.
It works great. You get access to better interest rates and that sort of stuff.
Yep.
Lower fees. And then as time goes on, as we were just talking about, as the equity in the property that you've bought goes up, 3, 4, 5 years down the track, you can release mum and dad's property out again.
As soon as you paid it off, the loan.
Well, you don't even have to pay the loan off. You just, with the equity, your property that was worth $500,000, 5 years from now might be worth $700,000. You can again use that equity and go back to the bank and say, well, guys, we only owe you $350 now, and the property's worth $600.
Yep.
You don't need mum and dad's place anymore.
Oh, great.
So can we revalue both of these and release mum and dad? So you don't even need cash to do it, or you don't need to pay out the loan. You just need your equity to be in the right position.
That's the perfect to step into the property. Yeah.
Yeah. The catch with it is a lot of the time mum and dad get nervous because obviously mum and dad are usually closer to retirement.
Yep.
They're starting to think about, retiring, not having an income. They're also thinking about, well, if little Johnny's not going to make payments on this, we don't want the bank to come and take our property.
Yeah. That is the question that I'm just about to ask. So just say for example, if the person actually guarantor, which is the mum and dad, it just happened that just the sons or the daughter actually lost the jobs, and couldn't make the payments. Does that affect the mum and dad in terms of the borrowing capacity, or if they are looking at buying for investment, say next year or the next 2-3 years time?
If mum and dad are?
Yeah.
It does. They're guarantoring the kids' loans. But I think mum and dad are usually worried about losing the property. And I mean, banks can generate a whole lot of their own bad publicity.
Yeah.
They don't need to be, evicting mum and dad from their property.
No.
Not to say that they don't do it, but usually what they'll do is they'll say, well, the kids are the ones not making payments. The kids owe us $400,000 or $500,000. If we can sell the kids' property and get our money back, that's great. We don't need to go anywhere near mum and dad's place. So that's usually the course of action. And it's not to say that they don't do some nefarious stuff from time to time.
Yeah.
But they don't need that. They don't need to be kicking out a 70-year-old out of their home. It looks terrible on Today Tonight or a current affair.
It is. Yeah. I mean, those scenario, those story, do come up every now and then.
Yeah, they do. There's not always, but there's usually a backstory to some of that stuff. Definitely, I don't think they. Like I say, I mean, I'm not sort of cheerleading the banks here. They've done some terrible stuff, but they're trying to be better corporate citizens. That sort of stuff doesn't look good it's not great for the bank's PR departments kicking 70-year-olds out of homes. So if they've got an option to say, well, can we sell the kids' property first? And then we all just move on, that would be the option that I believe they usually take. So.
Would that be the trend, say in the next year or in the next 5 years or 10 years time?
Parental guarantees?
Yeah.
They're very popular.
Yeah.
Because, and it comes back to trying to save $20,000 or $30,000 is hard, The other option, if mum and dad aren't comfortable putting the equity in their property on the line, they can gift the kids some money. So they can say, instead of saying, well, we're not comfortable putting our $1 million home that we've lived in for 30 years, we don't want the bank to take it. They can actually say, well, here's a gift of $20,000, $30,000, $40,000, $50,000.
Or they could even refinancing their property and using that cash and give it to their kids.
They can gift it to the kids
rather
and
than
say, the kids, here's a gift.
Sign up the mortgage documents and that sort of stuff.
Yeah. And that sort of circumvents some of that, the parents being a bit nervous about putting their whole property on the line that they don't like. They say, well, if the kids lose $50,000, that sucks. No one wants that. But that's a better option than the bank, getting their claws into our home that we've lived in for 30 years.
Because I was watching the news, whether it's the Current Affair or Channel 9, they were talking about how long does it take to actually save 20% these days.
Oh,
in the olden days where property is average about $300,000-$400,000, it could take like maybe 2-3 years.
Yeah.
But now they're talking about 8 to 10 to 15 years to save that 20% because of the property growth.
Yeah, and rising rents and all that stuff are making it harder because of your disposable
living
income
as well.
Yeah, cost of living is getting higher and higher. So it's tough. And like I say, with first home buyers, a lot of the time they've got the serviceability because you're earning reasonable money. Your credit file's good. It's that equity part of it that's the hard part. Either using mum and dad as a guarantee or getting a gift. Selling the motorbike or the boat or something like that. But saving it week to week at a couple of $100 a week.
It's getting harder and harder.
It's death by 1,000 paper cuts, like it's terrible. So,
and the RBA is still talking about interest hike probably in the next 3 to 6 months again, 1 or 2 hikes.
Well,
so that would be like 13 or 14 times interest rate.
It's just, it's crazy. Yeah. Well, the last one was a bit unexpected, I think, but I mean, I don't know what they're going to do.
Would you say that by 2025 there might be some sort of dip with the interest rate?
Yeah, I think you got to get a crystal ball out. It's, you know, if you're asking me to speculate, your lucky lotto numbers are 7, 15. No.
Because Philip Lowe probably, his term is actually on in September this year.
Yeah.
So who knows?
He's not a very
happen.
popular man, I don't think. But so he put the ones up last time. It is getting to the point, like as in the finance industry, if they're wanting people to slow down, definitely most finance brokers are the hurts there.
Have you seen any sign of slowing down?
Definitely people are ringing saying this is crazy. You've added in the, like you said, they've had, I think it's 11 or 12 in a row now. It's added, you know, $1,000, $1,500 a month in the last 12 months. And that's your pocket money. That's your beer, or you're going to the movies, or taking the kids to get pizza on Friday night.
AFL.
Yeah. So definitely people are ringing saying, what can we do here?
Because everything seemed to pretty much like, you know, increase at least 10 to 20%. When you're talking about grocery, you're talking about bills like, you know, insurance, you're talking about rates, you're talking about water bills, power bills, everything just gone up dramatically.
Yeah, it's crazy. It's definitely crazy. So coming back to, I think rates will, at some point, they've got to be getting to the level where they're achieving their aim of, you know, slowing down consumption, which slows down inflation. We've got to be near there somewhere. There is chatter about inflation having peaked. I don't know if that's true or not, but there can't be too many more rate rises to go. I mean, you want to slow the economy down.
Yeah.
You don't want to set fire to it and send it into recession, you know, which if they do too much more, I think, it'll start to have big counter.
Because apparently when you're talking about inflation, that they're trying to get down to about 2 to 3%, which
that's the target,
think it will take a long time to actually get to 2 to 3%.
Yeah. But once you turn that, once you sort of turn that corner, I think they're worried about it falling off a cliff. So you go from, you know, inflation, and then it decelerates so much that you've got to go the other way. You've got to start dropping rates.
Because with the current status that they're trying to do some sort of like, you know, what do you call it? Restriction with China, you know, ban the, you know,
international trade
barleys and all the other, you know, lobsters and all the other bits and pieces.
Yeah.
As soon as hopefully there will be some sort of an agreement will be reached between Australia and China.
Yeah.
But I think it's going to be a rough ride because, you know, at the moment things are not getting kind of, you know.
Yeah, I think it's a tumultuous world that we live in. Yeah, with stuff going on in Ukraine. International affairs is always tricky, but it's definitely we're in uncharted waters, I think. But the pandemic, I mean, you would have said if you were gonna, you know, you were in a first year economics lecture, and the lecturer said, "Do you want to write an essay on what will happen when there's a global pandemic?" If you'd said like the Aussie residential property market would boom, you'd just about be failed for that, you know? Like it's almost counterintuitive. So for it to go bananas like it did, there's a few people scratching their heads going, hang on, what's going on here? With the wisdom of hindsight, now it looks like they had grants and they pushed all this money into the economy and they sort of overstimulated the economy. That's what it looks like, I think. So, they sort of pushed that pendulum too far the other way. They were so worried about recession, the pendulum swung too far the other way. And as they rise these interest rates, you don't want it to come down the other way.
No.
Yeah.
Would you predict that, say, in the next 3 to 5 years, there will be more investors out there looking at buying property, or would there be more of a first home buyer?
Look, I think there's both. I think the Aussie, like, there's definitely a shortage of rentals in Australia. A shortage of property in Australia.
Yeah.
So there's that continued demand. You know, they're opening up the borders, so we're going to have more migration, which is going to feed more demand again. The doomsdayers will say that Aussie property is overvalued. If you look in America or Ireland or, you know, property fell off the cliff in the GFC. And
big time.
Yeah. So the doomsdayers say, well, Australia, that didn't happen to Australia, so we're due.
Let's hope not anyway.
Well, I don't think it is because we've got this rental demand, you know, or we've got property demand of people wanting to live here. So I just sort of can't see it happening.
So just to summarize what we have actually discussed today. So is there any recommendations that you might have for first home buyer or investors or mom and dad, as a bank guarantor?
Yeah, definitely. So if we look at those three things, so serviceability for first home buyers, maximising your income, having a good job, reducing your debts. So credit cards and personal loans and car loans, trying to minimise those.
As possible.
Keep your priority. If your priority is your house, you want to keep it to that. Your credit file, have a look at Equifax. You can go on there and get it for free and just have a look, or come to a broker and ask a broker to help you get it. Definitely, most brokers will do that. And then in terms of your equity position, have a chat either to a broker initially, and if you haven't got that deposit, then the broker and mum and dad, we all sort of sit around the kitchen table and work out, where we can get some 5%, 10%, 20%, where we can get that from, either as cash or equity in mum and dad's place.
Well, anyway, thanks so much for coming today on our podcast, Scott. Really appreciate your time.
No worries. Thanks for having me.
Thank you.